You already decided this. At some point, you chose S&P 500 or you chose a global index and you moved on. But then you start noticing things. DeepSeek changes the AI race. Japan is back. Frontier markets. What if the next decade of high growth comes from somewhere you barely own? So maybe you should switch. Except when you look it up, and in sterling, as far back as the data goes, S&P 500 up over 600%. Global tracker, 390%. That gap is real, and it has been real for a long time. So now you're back where you started. Did I get this wrong? Has a better answer been sitting there the whole time? More research, more debates, same question. The question most people are asking, S&P 500 versus a global tracker, which one's better, is harder to answer with conviction than you'd expect. What I want to show you today is a better question, one you can actually answer without predicting anything. In the portfolio structure video, I talked about how different parts of a portfolio have different jobs: core, calm, growth, curiosity. This video is specifically about the core, the part that carries most of the weight. For some people, it is their entire portfolio. For others, it's a larger proportion of it. So getting this right matters more than almost any other decision. And it's important to frame this decision to which part of portfolio we're selecting for, because what makes a good investment depends entirely on what job it is doing. A sprinter and a marathon runner are both elite athletes. You would not call one better than the other. They are built for different jobs. Same here. What works as a growth tilt may not be automatically right for the core. So if the core's job is clear, why does the question of what to put there keep coming back? The first route is to look at what has happened. We already saw the numbers. Over 13 years, the S&P 500 outperformed significantly. The gap is real, and it's been real for a long time. But that is not even the strongest version of the argument. Over the long term, across over 100 years of constructed data, the S&P 500 has delivered roughly 1 to 2% more per year than global markets. That compounds into meaningful difference over decades. It is hard to ignore. So you think the answer is obvious, but zoom in, just in the last 6 months, S&P 500 down, global tracker up. The gap has already flipped. A few months of underperformance, and suddenly the whole strategy is back under review. And this is not new. There has been periods, sometimes even over decades, where international markets outperformed the US. The 1970s, the late 1980s, the decade after the dot-com crash. The cycle turns, it always has. Past performance does not predict future returns. That is not just a disclaimer, that is the whole problem. The second route is to go deeper. Stop looking at returns and start asking why America has done so well. And the case is strong. Deep capital markets, the dollar at the global center, an innovation system that has been hard to beat for decades. So now the question isn't just, will the return continue? It is this whole system still defensible? And once you start asking that, the spiral starts again. Because now you're not doing portfolio research. You're trying to answer questions about empires, institutions, reserve currencies, and geopolitical order. Those are serious questions, and serious people disagree on all of them. The deeper you go, the bigger the question gets. You do not get closer to an answer, you just become more aware of everything you still don't know. At some point, you stop looking for evidence and start looking for authority. Warren Buffett says we should stick to S&P 500. Someone else quotes Dalio. And now you're not making a decision, you're picking who to trust. That is the third route, but here's the problem with it. What the authorities say is almost entirely context dependent. If you watch the whole clip, when Buffett recommends S&P 500, he was talking about passive investing versus active stock picking. He wasn't answering the question global versus the US. That context matters, and the context is almost never yours. And for every authority on one side, there is an equally credible authority on the other. So you can always find out. The authorities cancel each other out. So one route asks what has won so far. Another asks whether the reasoning in the one is permanent. A third asks who to trust. None of them give you a stable answer that you can actually build a portfolio on. That is not a research problem, it is a framing problem. They all frame this as a performance question. How did it perform and why? Whether it will keep winning, whether the right expert agrees. But there's a different frame, and it starts with being clear about what job core has to do. The core is the part carrying most of the weight. For most people, it is the majority of what they hold, which means the core is the part where being wrong costs the most. And here's the uncomfortable thing about getting it wrong. It almost never feels like a mistake while it is happening. Let me bring up an example that's closer to home. At the start of the 20th century, the UK was the world's dominant financial center. The obvious place to invest. London was the center of global capital. British companies spanned every continent. At its peak, the UK represented almost 25% of the global equity market. Today, it is 3.6%. And here's the interesting part. Britain did not collapse at a single point. It just stopped leading. And its share of global markets went from 25% to 3.6% gradually, almost invisibly, over decades. And at every point along the way, holding UK equities would have felt like the sensible, obvious choice. And that bias did not go away. Even today, one of the most popular default funds among UK investors, Vanguard Life Strategy, has a significant UK tilt built into it. Home bias runs deep. It always has. That is how concentration risk works. It feels fine, the market is still there, the companies are still there, the logic still holds, until you look up and realize the world has moved on without you. And if your core has stayed concentrated in UK equities over the past few decades, you would have far less exposure to core drivers of the global growth in this period. The Magnificent Seven, the US tech boom, Japan's recovery, China's growth years. Not because you made an obvious wrong choice, but because you stayed with the winner and gradually you stopped winning. So the UK story is not really about the UK. It's about what happens when you make a concentrated bet without realizing it is a bet and how long it takes to notice. So what does a core actually need? It does not need to pick the winner. It needs a broad enough exposure so that future winners are likely to be included. Which means the right question is not which market wins. It is how much of your future are you comfortable betting on one market continuing to lead? And the answer doesn't mainly come from reading the market. It comes from being clear about your own tolerance for concentration. Were you ever actually comfortable with the full dependence on one market before any of this noise started? That question you can answer today without forecasting anything. So if the question is concentration, what does that actually look like in practice? First, some perspective. S&P 500 is already a form of diversification. 500 companies across many sectors compared to how most people's wealth is actually structured, that is not nothing. Think about it. Your property is one postcode. Your share incentive is tied to one company, the same company your salary and bonus already come from. In real life, most of us are far more concentrated than we realize. The S&P 500 is often one of the least concentrated things in the picture. So this is not about saying the S&P 500 is a bad choice. It is about asking whether the level of concentration is appropriate for the core's specific job. And when you look at it that way, here's what the direct comparison actually is. The S&P 500 is full exposure to one market, one country, one currency, one regulatory system. A global tracker is already roughly 60% US. The rest is spread across Japan, Europe, emerging markets, and others. The S&P 500 leaves out roughly 40% of the world's investable stock market. That may be a reasonable, conscious choice, but it is a choice worth making deliberately, not by default. Now, one objection comes up here often, and I had to stop myself. S&P 500 companies operate and earn revenues all over the world. Apple sells in China, Google runs on every continent. Doesn't that already make you globally diversified? I spent some time digging into this. S&P 500 companies do earn revenue globally, and that provides some exposure to international growth. But your investment is still subject to US market sentiment, US regulatory decisions, and significant dollar movements. A global tracker gives you something structurally different. Direct ownership of assets across different markets, different currencies, different regulatory environments. It's not that one is right and one is wrong, it's that they're genuinely different kinds of exposure. And there's something worth understanding about how a market cap weighted index actually works. It is self-correcting. If the US keeps dominating, the US weight stays high automatically. If another region starts to lead, its weight increases. If a market fades, it shrinks. You don't spot each shift yourself. In a market cap weighted index, those changes are reflected over time. This is what a passive looks like at a global level. You're not betting on which market wins the next decade. You're owning a system that adjusts automatically when the market leadership changes. The S&P 500 does this within one market. The global tracker does it across all of them. So what does this actually change? It means this was never a performance question, it was a concentration question. And once you see that, the decision can feel much simpler. You don't need to resolve the geopolitics. You don't need to pick between Buffett and Dalio. You just need to ask yourself one thing honestly. Before the headline changed and someone you follow shifted their views, were you actually comfortable being fully dependent on one single market over the next few decades? If the answer is yes, the noise does not change it. You made a deliberate choice, own it, stay in it, stop reopening the case every time the sentiment shifts. If the answer is no, the noise did not create a problem. It just exposed a question that was already there. And now you have a way to answer it properly. And there's one more benefit to a global tracker that is hard to quantify but worth naming. It reduces the decision load. The next time the headline changes, you do not need to start over. The index adjusts, you don't have to. Time is the most valuable asset you have, and money should support that. It should run quietly in the background and gives you more of it, not consuming your attention every time markets move. Keeping the decision load low is a design choice. A portfolio you can hold without constantly defending it to yourself is not a compromise. It is the point. And if your next question is about how broad is broad enough, all world, developed markets, or cap, the honest answer is simpler than it sounds. You do not need perfect diversification. You just need enough to capture the market return without second guessing it. I cover that properly in chapter 4 of my book, The Compound, link below. And by now you have seen why that question does not have a stable answer. The more you research it, the bigger it gets. Past performance, structural analysis, expert opinions, they all keep the debate open rather than closing it. So the real question isn't one that more research can answer. It is, how much of your future do you want riding on one market continuing to win? That question does not require forecast. It requires honesty about your own tolerance. And that is something you can answer today without reading another article, watching another video, or waiting for the next set of charts. If you want help applying this to what you are holding, I've linked the current way to work with me below. And if you want to keep building from here, I've linked the best next video below. The goal was never to find a perfect portfolio. It was to build something you can hold quietly, confidently, without having to revisit it every time the world gets louder. Thank you for watching. I'll see you in my next video.